Welcome to The Explainer. Today, we're diving into a real head-scratcher, the story of Glottis Limited's IPO. This was a company that looked like a sure thing, but well, the market had some very different ideas. And that's really the core question, isn't it? How does a company with booming revenue and shrinking debt, a company that looks fantastic on paper, get such a brutal welcome from the stock market? Let's unpack this mystery. So here's how we're going to tackle it. We'll start by looking at Glottis's incredible growth. Then we'll break down the IPO itself. After that, we'll get into the market's, well, let's just say lukewarm reaction, the plunge that followed. And finally, we'll try to figure out this bizarre disconnect between the numbers and the mood. All right, first things first, let's get to know the company at the center of all this. Who exactly is Glottis Limited? So Glottis is a big deal in India's logistics world. You can basically think of them as part of the circulatory system of the entire Indian economy. They've been around since 2004, moving all sorts of goods, especially with the huge e-commerce boom happening over there. They're an established player in a red-hot sector. Now, just take a look at these numbers. I mean, wow. Their revenue nearly doubled in just 1 year, jumping to over 940 crores. And look at their profit. It more than doubled in 2 years. These are the kinds of explosive growth figures that usually have investors tripping over themselves to get a piece of the action. And it wasn't just about making more money. They were getting financially healthier too. This right here shows their debt-to-equity ratio. They took it from a pretty high 2.7 all the way down to a super healthy 0.2. Basically, they paid off a ton of debt, making the company a much safer bet from an investor's point of view. Okay, so with financials this strong, it's no surprise they decided it was time to go public, to issue an IPO. So how did they plan to do it? Now, this is a really important point. A big chunk of the money they wanted to raise was a fresh issue, meaning it would go right back into the company's pocket to buy more trucks and more containers. This was a clear signal to the market. Hey, we're not just cashing out, we're doubling down on our own growth. And here are the nuts and bolts of the deal. It was a decent-sized offering, pretty balanced, about half the money for the company to grow and the other half to let some of the early owners sell a piece of their stake. You know, a very standard, very reasonable setup. Nothing weird here. And you know, they even made sure to set aside the biggest slice of the pie, a full 40%, for everyday retail investors like you and me. That often shows that a company feels pretty confident that its stock is priced attractively for everyone, not just the big institutional players. Okay, so everything looks great, right? A solid company, a smart IPO plan. But this is where our story takes a sharp, unexpected turn. How did the market actually react to all this? The reaction was, let's just say, not great. The IPO was only subscribed about 2 times over, and that was only because a bunch of wealthy investors jumped in at the last second. In a world of IPOs that get oversubscribed by 50 or 100 times, this was a seriously muted response. And if you want to see the investor excitement just completely evaporate in real time, look at this. The gray market premium, it's kind of like the unofficial buzz meter before a stock lists, started out at a healthy 20 rupees, hinting at a nice 15% pop on day 1. But by listing day, poof, it was gone, down to 0. All that initial optimism had vanished into thin air. So, with all the pre-show hype totally gone, the big question was what would actually happen when the opening bell rang and the stock started trading for real? So remember this number. 129 rupees per share. That's what investors paid in the IPO, believing they were getting in on the ground floor of a great growth story. And this is what happened next. The price cratered to $66.97. That's a drop of nearly 50%. For anyone who bought into the IPO, it was an absolute bloodbath. And the aftermath was pretty grim. The stock was hitting its all-time low. Its P/E ratio, which is kind of like a price tag for the stock, fell to just 12.5. A low PE can mean the market doesn't expect much growth in the future. In essence, the market had decided Glottis was worth half of what the IPO priced it at. Which brings us right back to the central mystery here. Why? Why was there this massive, painful disconnect between how the company was actually doing and what the stock market thought it was worth? This slide just lays it all out so perfectly, doesn't it? On the left, you've got the fundamentals, rock solid, incredible growth. And on the right, you have the sentiment, a complete and total collapse of confidence. It's a tale of 2 completely different realities. So what could have been going through investors' heads? Well, it's possible they were looking past those shiny financial reports and focusing on the potential storm clouds on the horizon.
Things like rising fuel costs, tons of competition, and the risk of a slowing economy. All of these things could have made even a great-looking company seem like a risky bet.
And that brings up a really interesting way to look at this. One report on the IPO said the market's reaction was measured and rational. Now, that might sound crazy given the price drop, but what it suggests is that maybe, just maybe, investors weren't panicking. Maybe they were looking at the long-term challenges and simply decided the IPO price was too high. Maybe the market was being smart, not scared. The story of Glottis Ltd is such a powerful case study, isn't it? It perfectly illustrates the two competing forces that drive stock prices, the hard numbers on the balance sheet and the unpredictable emotions of the crowd. So it leaves every investor with a critical question. When it comes down to it, who do you trust, the numbers or the buzz? There really is no easy answer.